All right, good morning, wherever you are. My name is Michelle Reyes, and I'm here to share some information if you are a parent. Life happens. This is the lifetime gift for a child from a parent. To build wealth, it takes more than a piggy bank, and I'm going to show you a very unique way to save for your children's future. Bit about where we are. So we have 6,000 plus agents strong throughout the United States with a corporate office in North Carolina. A bit more about me. So again, my name is Michelle Reyes. I've kind of been an entrepreneur since birth. I was a physical education teacher for 15 years in New York. I did business education here for 7 years in Miami. Then I got my real estate license and have done real estate for the last 20 years. During COVID, I added insurance to my scope of services along with becoming a mobile notary. Begin this presentation. So what do we do? So what do we do? We protect life's journey from birth to retirement and beyond. We have many different ways we can help people, from general life insurance to health insurance. And today we're concentrating on asset management and wealth strategies, utilizing an IUL for a child from 1 years old to the age of 18 years old. So this is about funding your children's lives, again, from preschool to college and to all the moments in between and beyond. So as a parent or grandparent, you may wonder sometimes, what is the greatest gift you can give your child? Um, how do you put something in place that will last forever? And three, how can you leave a legacy if you're not a millionaire right now? It doesn't matter. Saving starts with the moment you decide, and starting right now, if you haven't in your life yet, is always the best day to start. Okay, so in this presentation, we will show how a parent or grandparent can provide for their child with $1 million plus retirement, college savings, first house, rainy day money, income for life's journeys, funds to help pay for a serious illness or injury, setting up a legacy for their loved ones, all done risk-free and tax-free. All right, so how do we do it? So before I get into that, I'm going to just talk a little bit about the evolution of life insurance. So just like cell phones evolved from a brick to a little tiny gadget you can put in your pocket, and uh, iWatch and all this technology, insurance has evolved as well. So to earn market-like returns inside the policy, tax-free. So initially, the first company to offer it in 1997 was Transamerica. And since then, 24 years later, there's 52 other companies also offering the index universal life or some form. So to summarize, the key benefits besides protection and accumulation, this is basically lifetime coverage. It builds savings with positive compound interest. It has the living benefits. It has access to your money tax free. Don't pay any capital gain on it. There's flexibility, there's security, there's support, and there's protection. So here we are. If you have a child, and some parents had or have the 529 plan or thinking of having the 529 plan, here's some reasons why the IUL is so much better. So if you look at the pros and cons of both, cons, the 529 is not an insurance plan. So there's restrictions on using it for educational purposes only. And if you don't, you can be penalized and lose money on all this money that you saved. And I like to tell parents this: how do you know for sure that your kid at 1 years old that they're going to want to go to college? Life has changed. People don't even go to college anymore, and there's so many little certifications you can do instead. And we're in a world of entrepreneurism. So by having the 529 plan, God forbid your child didn't go to college, you could actually lose money. Also, the 529 has no protection from market downturns. You don't have access to the funds due to chronic or critical illness, and with the IUL, you do. It's not counted as an asset when applying for federal financial aid if you have an IUL, whereas the 529 is considered an asset, means you can pay more money on taxes. So with the IUL, funds can be accessed anytime after year one. Minimum withdrawal is $500. Okay, so let's do some math here. First of all, we're going to pretend that you're saving $100 a month in the first scenario. Second scenario, you're saving $250 a month. And the third scenario, $500 a month. And this is saving until the age of 21, and then you stop. Face amount you get is $182,000. And that face amount is going to grow through the course of time. So by the time of age of 21, that $100 a month that you've been investing in, that is $36,000 and $641 that your child now has either for college, their first house, their first car. They have some options. And if they leave the account open, and let's just say they're not investing any more money into it, by the time they're 65 years old, even though they haven't been putting any more money in it, uh, at age 65, it would accumulate to $1.2 million. The death benefit at age 65 is $1.4 million. The great thing about doing this really early in life, even with the $100 a month, is that you guarantee that if they ever did become uninsurable, they cannot lose their plan. And the issue in America with a lot of people is they just absolutely wait till it's too late. And then that is when insurance is expensive, when illness is present. So column number two, let's say you save $250 a month to the age of 21. That would be a lifetime savings of $63 that you put into this account. The face amount of this policy would start at $485,000. That's like $500,000. God forbid something happened to this person. That would be the death benefit initially, but that death benefit grows with time. By the time of 21 years old, the cash accumulated value is 121,000. So could you imagine turning 21 years old and your parents having you set up with this? It makes a big difference, folks, when you have options, options to go to school, options to kind of do anything that will empower you. And a lot of times everything requires a little bit of capital, a little investment. So this is a great strategy to prepare your child for life. So by the time they're 65 years old, if they keep this account open and they don't liquidate all the funds, $3.2 million is what they would have in that account. So this is a retirement account. So the idea is to open it and to fund it to the age of 21 and let it keep riding. But all right, so we're doing the math. This is just a chart. I'm going to leave it on here for a second so you can possibly do a screenshot for yourself. This is just an example of the face amount going in. I'm giving an example of a boy, $100 a month to the age of 65. In this scenario, they do put the $65, the $100 a month till the age of 65. So while I'm here, I would say, so if your kid is, let's pretend 6 years old, and you do $100 a month, the face amount going in is 321,000. By the time they're 21 years old, you'll have a little $20,000 in there almost. By the time they're 65, the cash value on the death benefit increased by twice the amount. Started out at 321 and now it's at 661,000. And by the time they're 85 years old, there's $2.6 million in there as far as the cash value. And the death benefit at age 65 is 807,000. I want you to look at this case scenario. That means in the lifetime of this policy, you as the parent or your child put 70,000 in, but it has a death benefit of 807,000 at 65. And here at the age of 85, the cash value is $2.6 million. So that's pretty incredible. So this is how I said with this policy, you can do that. So how the IUL works, basically you make a monthly premium payment. It accumulates the value of the policy. You have the option of doing withdrawals and loans. I would always recommend a loan and not a withdrawal because the loan keeps the policy alive and the cash value remains the same. If you take a withdrawal, then you're depleting the account value. The fourth time that you can, this a phase of this policy is the policy death benefit, and that's the amount that would go to the beneficiary. So IUL for college and beyond, these are just some quick numbers on if you are a parent and basically what you're looking at if your kid did go to college. So the average cost of college in the United States of America is $35,000 per student per year, including books, supplies, and daily expenses. The average student attending a public school institution spends about $25,000 for an academic year. Okay, so a legacy begins when one member of the family starts it. There's no other plan like it in the market. This plan includes retirement tax-free, loans tax-free, living benefits tax-free, death benefit tax-free. The banker's bunker. Have you heard where banks save their money? It's called BOLI. So BOLI stands for Bank-Owned Life Insurance, a product where the bank is the policy beneficiary and usually the owner, commonly used as a tax shelter for financial institutions. So here's what I'm telling you guys. Did you know where banks invest their money in? Banks invest their money in insurance. They have their own life insurance as an asset. And these are just some of the numbers, assets per billions per bank. So you might recognize some of these names. So Bank of America invest over $95 billion into insurance. JP Morgan Chase 68 million, Wells Fargo 29 million, 59 million. So look, guys, wake up. The safest place in the planet to invest your money in for guaranteed legacy is the only place is an insurance policy. So you can schedule an appointment for your free illustration. That is the Calendly link. You could eliminate the IUL at the end, and that should get you there. You can utilize my website and go to retirement and make sure to text me your email to 305-956-6825 so I can get you out a free gift. Should you know anyone looking to possibly change careers, we are looking for digital agents on demand that want to service customers on Zoom, one-on-one education, and that is the website there. Thank you for being here today. This is Michelle Reyes.